But a quick word on the Henry Jackson Initiative. You'll all have packs in front of you that reveal a little more about what we do. But in a sense, already you've lived through it today in the discussion. What we do is we convene seminal points about what we call inclusive capitalism. We look at various aspects of that. We draw into debate, discussion, and try and suggest practicalities in terms of how we can actually help resolve the intricacies and confusions within the capitalist system and improve them so they work for the benefit of all, instead of what we may have seen earlier. Adam started off by referring to the fact that the world is a less pleasant place, perhaps, in 2004, and that really was, in a sense, our starting point. If you look at the sort of confusion engendered by the financial crisis and indeed by the economic crisis that's followed since then, I think fundamental questions have been asked about the system of capitalism and what it does for its many stakeholders. But I think we started from two premises. The first was that capitalism remains the best system for improving the lot of everyone out there in terms of incomes, in terms of betterment, in terms of life improvement. And that still remains true. But of course the second part of that is it can be improved. It must be improved. And it can only really be improved by all its stakeholders, businesses, labour, workers coming together, consumers coming together and understanding that we're all in it, to paraphrase the very British coalition phrase, all in it together to make this a much better system going forward. And how did we do that? Well, if you look as part of your pack, you have the task force report on inclusive capitalism, which was our first major initiative. It was brilliantly chaired by Frank Barton and Lynn Forrester de Rothschild, who of course led a team of very distinguished practitioners and intellectual thinkers, including Adam Posen, on the subject. And we of course produced this report, with the aim of which was to, in fact, frame the challenge. What is it that we mean by inclusive capitalism? And I know Lynn will speak about this a little later, about where we're planning to go with it, what the the journey has been on this. But it also suggests ways and areas in which we can make progress. So if we look at areas such as education for employment, looking at SMEs, how we can improve the way that they contribute to the economy, and of course if you analyse other areas such as long-term governance and see how companies can make improvements. The core aim being that in reality we don't need governments to make the decisions for us. All of these things can be handled in partnership together. We had two launches, one in London, one in New York at Bloomberg, which sort of framed those areas. And now I'm pleased to say with today's discussion we're moving away from, if you like, the macro approach into the more micro areas, looking at various parts of the challenge ahead, seeing how we can probe and tease out solutions and answers on both sides of the Atlantic going forward. A couple of things that we're doing, for example, in London right now, to give you a sense of some of our activities. Firstly, we are, next month, we're announcing a very interesting prize looking at youth unemployment, the best essay to solve youth unemployment. It's being run in the Daily Telegraph. The Reed Foundation have kindly sponsored the £10,000 prize for this. And having seen some of the entries, I think it's firstly a great experiment to see people from all walks of life actually writing in with their solution suggestions for how to make this endemic problem that affects our societies work better. And we're looking for a solution, I think, not to prejudge the process, which could work anywhere, whether it's in Britain, America, anywhere, to solve this problem. And as you know, in some countries such as Spain and Greece, it's reached crisis levels in terms of 50% or more of youth unemployment, causing a problem for those societies. But I do want to stress this transatlanticism. I'm delighted we're here in Washington to launch the next leg of this, to look at the labour issue. It's really very important to us that there is a debate going on both sides of the Atlantic, because we live in a globalised world, and in a globalised world we need to draw on the experience and on the globalised nature of solutions in order to make the system a better one for one and all. And of course that does require your help as part of that as well. In your packs you have a little leaflet which we hope you'll fill in with your details if you want to be involved in our work going forward. I can assure you there's plenty more to come on this. There's a whole raft of measures with specific companies and indeed more areas that we're looking to work in 2013 and beyond. And with the inspired leadership of Lynn and Dom, and of course with friends like Adam and the Peterson Institute, we do indeed look forward to working with all of you to try and deliver that agenda for change. Thank you very much.
And Dick, you used that term that's so good, the virtuous cycle. And so the Gephardt Group is working with management and labor. But behind that, you had, I might say, a Canadian private equity fund in your spirit. And by the way, the reason I said the Canadians is I'm surrounded by Canadians. Not to mention that the new governor of the Bank of England is Canadian, so watch this space, ladies and gentlemen. But so you had an investor that was willing to work with your CEO. And so I really think that the virtuous cycle is not only management, labor, customers, but enlightened investors. And I can't help believing that we would have more enlightened managers if we had more enlightened investors. And I have huge respect for a CEO like Paul Polman, who said, if you care about sustainability, if you care about fairness, come and invest in my company. If you don't care about those things, you're a perfectly fine person, but find another company. Very brave and an extraordinary person. And so on this panel, we're going to explore that part of the inclusive capitalism agenda. And if I may, I would like to start with Jim Leach on my right, who is the CEO of
right.
Sorry, you two look alike to me. All Canadians look alike, sorry.
We'll get our chance.
You two, you'll get me. You two are separated at birth, I know it anyway. On my left, Jim Leach, who is the CEO of Ontario Teachers Pension Plan. It has 300,000 plan members. And I want Jim to describe more of this later, but until 1990, from what year? From 1917.
1917, yeah.
It was a government-run pension plan. In 1990, the government, working with the teachers' union, decided to privatize. They privatized it with $17 billion of assets. Today, that pension plan has $127 billion in assets. The Economist magazine did an article on the, quote, Canadian model for pension investing, focused on what Jim is doing with his type of direct, hands-on investing and his concern for the long term. Just a little bit more on Jim. He is not a lifetime investor. He's a lifetime manager. It's the kind of people Dick is working with. He managed 2 big Canadian companies, made them bigger, and moved on. Became CEO in 2007. The Ontario Teachers Pension Plan has been the #1 performer among pension plans for the last 10 years. He outperforms the median by 700 or 800 basis points. So Jim, I'd like to start by asking you, as an investor representing 300,000 people who rely on your performance, you do that thinking about the long term, and what does that mean to you?
Well, first of all, I mean, we are fortunate in that as a pension plan, we have a horizon of about 70 years. We have to concern ourselves not only with people who have retired and people who are now in the profession, but we have to also concern ourselves about people who will eventually join the profession, in fact, teachers who aren't even born yet. And so we call it a cycle of about 70 years. So once you put that hat on, you are talking long term. By the same token, we do have short-term pressures, etc. And so that it is difficult to, I mean, there are certain parts of our operation which one would say is short-term focused, but the bulk of it is long-term focused. It's interesting, if I can, the World Economic Forum about 3 years ago set out to try to figure out how many long-term investors are out there. Like everyone talks about it, that they're a long-term investor. Yeah, they're long-term until the first hiccup, and then they all of a sudden become very short-term. So they sat down and first of all came up with a definition, and that was an investor who was going into an investment, purchasing an asset for long-term either capital growth or income growth. But it also had a qualifier in there, and it said, and was also capable of holding it for the long term. Because there are lots of people who go in and say, oh, that's a great idea, I'm going to buy it for the long term, but they're not necessarily capable of seeing it through to the end because they've got constraints on them. Constraints such as liquidity is the most obvious one. So in their study of this is about 2009, they figured there's about $65 trillion of funds that are managed professionally in the world. They figured about half of that is in the hands of people that you would stereotypically think of as being a long-term investor. So half of the 65. And stereotypically, you'd think of pension plans, you'd think of endowments, foundations, life insurance companies, sovereign wealth funds, and probably family businesses. I think that was the group. So they figured they represented about half. Then they looked at the constraints that were on those groups to see how much of that money could in fact be deployed on a long-term basis. And they came to the conclusion it was about 25% of that. So of all of the funds in the world, the conclusion was that about 1/8 of those funds actually legitimately could be considered as potential for long-term. And why did they think that was important, or what was the objective here? Is why is being long-term important? Is first of all, they felt it brought stability into marketplaces. That's one thing that long-term investors do. Secondly, it is probably the only way, or those are the types of investors who are going to rebuild the infrastructure that is so badly needed in the Western world, so badly needed to be rebuilt. And finally, it was sort of major energy projects, particularly green energy, etc., where the most likely place you'll get those investments are from long-term investors. So that was the three areas that they were focused on. But it is only about 1/8 of all of the money out there can legitimately be deployed this way.
And when you look at investing, what is the approach that you take in looking, for your investments?
Well, I mean, first of all, the obvious approach is to make money. We're in here to meet the promise for 300,000 teachers in the province of Ontario. But our investment style is different. First of all, we believe that in most investors of our nature are too highly diversified. And they, over-diversification is one of the biggest issues that many of our brothers and sisters in the industry struggle with. If you're over-diversified, all that basically means is you're going to, at best you'll meet the index minus all the costs, so you're never going to do well. We think for far more impact, you should have a far less diversified portfolio. Then that leads you to larger stakes in a smaller number of companies, which then leads you to the ability to engage with those companies and really understand what's going on inside them, engage with the boards of directors, engage with management to help them as they go about trying to build their businesses. And with a kind of a long-term stable investor such as ourselves as partner to management, those companies can take a different view going forward. They can afford to make large investments today that aren't necessarily going to pay off next quarter, but will pay off in 5 years when we're still there prepared to reap the benefits of that. But it's not every investor. I mean, there are various conditions and the environment in which we operate that has to be right to do that. And first of all, governance is probably the biggest, and that is the people who are on my board of directors and oversee what I'm doing have to be professionals. They have to understand that's what the strategy is. They have to understand that the first time, let me just give you a great example. When teachers first went into the private equity business early in 1993 or 2 to do it, and they made a determination to do it themselves. They weren't going to give Henry Kravitz a whole bunch of money so they could be charged fees. Instead, they were going to try and do it themselves. The very first investment they made, very small, was in a nursery business, a flower business. They made an investment of $20 million. And we're patting themselves on the back for it. It was a pretty interesting investment. Went bankrupt, and they lost every penny within 4 weeks. Okay? And I always tell people, when I ran the private investing side, I had this boardroom, and it's still there. And on the walls are all of the transactions that we ever have done, good, bad, and ugly, for the whole, since it started in 1992. And there's there, White Rose is up there. It's the very first one, you see it. But I always tell people the most amazing thing is there's actually a wall there that has names on it that goes all the way to 2013. Because, you know, most organizations would have said, we tried a drill hole or a dry hole on the first go, tried that, let's get out of here. And that isn't what happened. The board said, we're in the higher, you know, private equity is a higher risk area. You know, what did you learn? So there's the other side of it is you have to be an organization that's prepared to learn from its mistakes and go forward. So the governance is key. The types of employees you have are key. You have to have a staff that, you know, has got some experience, has got some credibility, and has been there for some while. I mean, if you're churning your staff over all the time as an investment organization, it's impossible to take a long-term view.
What about in looking at your investments? Do you focus on the kind of things that Tom and Dick were talking about? Obviously, at the shareholder level or at the board level, you're not dealing with the unions per se, or the workers in a company. But do you find yourself probing companies in how they're educating their workers, how they're creating workers for the future? In the Henry Jackson Initiative work, we were very impressed by the work of Rolls-Royce. Rolls-Royce created a Rolls-Royce Academy, and the Academy did what Tom was talking about, and that Germany does often, which is to create apprenticeships. And people came in, and they go through this program, and then they're inculcated with being Rolls-Royce. And it's about a 25-year-old program, and 40% of their top execs have gone through that. Is that something that, as investors, we should encourage, or is that a kind of a hit and miss?
I think we would. I could answer that by saying we look at all indices of success and what companies are doing. I mean, in our investment portfolio, we span, from investments in public entities where we'll own 2 or 3 or 4%, all the way up to organizations where we own 100%. And obviously, the ones that we own 100%, we spend a lot more time and have a lot more access and understanding of what's going on. So those are the organizations that we have the most impact on. By the same token, in our public company portfolios, they are concentrated. They're not highly diverse, and we're very active on the governance front.
Okay, so maybe on that I should turn to Dom. I think Adam said it well. He is the guru to all corporate America. He's the managing director of McKinsey. And on a personal note, working with him on the Henry Jackson Initiative on Inclusive Capitalism has been remarkable. His devotion, his integrity, his desire to get things right and to hear all sides is remarkable. And there are lots of points that I could go to you, Dom, on. But recently, McKinsey issued a report which you've personally written about education for employment. And if you could tell us a bit about that job and how it relates to what we're discussing today on management and job creation.
Sure. Yeah, and in fact, it really was driven off one of the three pathways that are in that report that we all worked on together. One of the first pathway was sort of education for employment. How can business play a broader role in creating more employment given the situation that's going on? And the second one was around SMEs, and the third around long-term investors, which Jim led the charge on where it is. But with that background, what we did was follow that up and did a survey. As you know, today in the world, there's about 75 million youth that are unemployed, right, which is a pretty staggering number. I think it was mentioned, someone mentioned before about the percentage of youth unemployed in some countries like Spain. It's over 50.5%. I was in Saudi Arabia just before Christmas. It's 40% youth unemployment. And this is, I think in many ways, a crucible of where the system could come to a crisis, because I think people say this capitalism, this is a great system, but how come I'm not going to have a future in terms of where it goes? Or as Lynn, you like to quote, I think it's a wonderful term, that the elevator isn't working in the apartment building for people in the bottom to the penthouse. There's no elevator to be able to work if people can't work. So that was the context. And what we found in that work is that when you see the 75 million youth that are unemployed, and you've got, at the same time, a lot of businesses that can't hire the people that they need. And this is something actually that Dick and Tom were talking about. There's a need for skills to be able to do it. So even in the U.S. today, with roughly 12.5 million unemployed people, there are 3 million unfilled jobs. And that's not just the frictional unemployment, it's just the skills aren't there. And so you have this dichotomy, and that's in every single country. We found the same thing. We've got growing youth unemployment, and we've got actually a growing gap between what employers want to see that's there. And then you have educational institutions that are doing their best too, but believe that they're creating the skills, if you will, for people to work. So we sort of found it as there's like three parallel universes going on. There's youth that want to find jobs. It's unclear. It's very difficult to find out what are the opportunities that are there. It's very intransparent to people when they're making that decision at sort of 16, 17 years old. You've got educational institutions which are very much focused on what it takes to get in. They don't spend, I'm generalizing a bit too much here, but they don't spend a lot of time talking about what happens to their students when they go out. What are the sort of the jobs that they get in terms of where things are. And they've got employers who don't feel that they're able to influence the system to get people coming into it. And so that's sort of the context. And what we found in it is there are some very good examples out there where people are doing things. John Peace, who's part of our task force, who's the chairman of Standard Chartered Bank, has actually himself just said, I've had it. This is crazy. Let's start doing it in the UK. And he's actually got business people together. Let's try apprenticeships. Let's see whatever we can do to try and move it forward. And there's some very good progress. The challenge is getting scale, because again, we're talking 75 million. So if McKinsey in Ontario, we all do our little thing, it's not going to add up to much. And so the view is, how do we get a at-scale program to be able to move? And what we're finding is that there are some areas. There's an example, I always mispronounce the name, but it's in Brazil actually, called PROMIMP, P-R-O-M-I-M-P. I'm probably butchering the name of it. But it's basically in the oil and gas industry, which, as you know, is a booming area. And what's happened is you have a consortium of business, educational institutions, and local government that's got together to say, you know what, we're going to have to create the skills that are required for people to be able to work in this industry. And they've actually now affected 90,000 people. And again, that's not in the millions, but that's over a 3-year period. 90,000 people have got jobs, and they're very systematic. They've actually gone around to the different companies in the oil and gas industry in Brazil, in a particular region, and basically said, what's your pipeline over the next 5 years of projects that you need to get done? And then they've very systematically and boringly, if you will, drawn that back to say what types of jobs. And there's 190 different categories. I couldn't tell you what those all are, but there's 190 different categories of skills that are required, and the educational institutions are there, and you've got a very nice symbiotic method there. It's going to create work, it's going to create GDP growth, it's going to be good for the government, and it's a wonderful thing. So we're seeing that. The UK has started to build just a transparent system so that youth can actually say, what sort of jobs are actually out there that I could get? What's available for me? How much do they pay? What are the requirements that are needed, and so forth, so that people could do that. And then Singapore, while it's a small country, so you have to be careful about extrapolating too much from that. It's very interesting to see there how the polytechnics, and I don't think we talk enough about the vocational side of things. Dick, you've talked about this before. We focus too much on broader university. I think we don't spend enough time on the vocational institutes. And what we've seen is that the ability to be able to provide training at the vocational level allows people to be able to create more jobs. And we're seeing examples of that in different parts of it. So the notion, too, of the type of educational institution, Germans in particular have done a great job. If you go to a vocational institute, you're not seen as a loser, if I could say. You're actually proud to have gone to it. You're actually well paid. You move into other roles. I think in Canada, England, in the US, the vocational thing is not the first thing that you'd be talking about when you're introducing yourself to people, and yet that's where a lot of the jobs are. So we're also looking at ways to try and build that in different countries. I think there's a lot we can learn, as Alan said, from experiences that are there. But what the Singaporeans have done have brought their 3 polytechnics together. There's the Minister of Education, and there's 4 CEOs that get together, and they literally map out jobs. And I've actually met with them, and I said, that's probably a system that's a little restrictive. I mean, what if I want to do art history? Well, you're telling me I can't do art history. And they said, no, you can. But let me give you an example. When I was there, we think that there are 900 jobs that are required in various water technology areas. And so what you're going to find is in the polytechnics and the education institutions that we have here, there's going to be a lot more spaces to do water technology. You're going to have to be really, really talented and smart if you want to get one of the 3 or 4 places in art history, if that's what you want to do. So they're trying not to restrict it, but they're trying to tailor it, if you will, to where it is. And that's actually, I think, quite an interesting system, because they try and look ahead. It's not perfect, but it's all groups together, again, education, business and government, trying to figure out ways to be able to move it forward. So that's kind of where we are.
Yeah, a lot of what you said was government acting. How much do each of you feel that business, not for corporate social responsibility, not for philanthropy, but for its own good, should think about training, should think about small and medium enterprises, should think about, well, the environment, there's a whole group that says that, and maybe that's part of this question, that whole movement toward the ESG, the environmental, social, and governance investor. Do you think that managers should think about these things and investors should encourage them to think about these things? Or is it really something that should stay outside of the bottom line, and that managers should focus on the bottom line, which in many cases, as we've seen from what Dick and Tom said, the bottom line is enhanced by working with workers. But is there even a larger agenda beyond that investors should ask managers to do?
Let me try to address that. I think that maybe make 2 statements on it. One is there's no question, and I think the World Economic Forum is saying it this year, that the greatest threat, that if you talk to any business person, the greatest threat that they see going forward is income disparity, which could lead to civil unrest. That is number one. I have yet to meet any business person who doesn't say that's a big concern. And so that gets you involved, whether you like it or not. You're engaged. And you've got to start thinking about what you can do, what your organization can do to help address and alleviate that issue. I'm involved in issues totally separate from Ontario Teachers' Pension Plan in education, public education in Ontario, in Canada actually, an organization called the Learning Partnership. And we just held a major symposium or conference in 2 days in February, which had government, business, and professional educators, academics there. And it is, I can say, the first time I've seen so many business people at it, totally engaged, and in fact leading many parts of the sessions, and not just saying, you've got to be producing people that we need, workers for the future, yada, 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 but much more into what are things, how can business play a role to help transform the system to what's going on in the real world. Talking about flipped classrooms and curriculums and et cetera. So it's the first time I've seen that many business people, senior people, seriously engaged.
It's like de Tocqueville said about America, that we have a sense of self-interest properly understood. And maybe we've gotten off the track, but what you're talking about, we're coming back to the track. How do you feel when you're consulting with CEOs around the world in their genuine interest in whether it's the inequality debate or the environment debate, the governance debate?
I definitely agree with Jim. I think there's a quite a big shift that's going on, and it's kind of a shift away from, it's not corporate social responsibility is there, but it actually is you need to do things to help the community that you're operating in, and that's where you should focus your effort. Let's go back again. In many ways, it's going back to the future, because it's what Adam Smith said in his first book, that Theory of Moral Sentiments, right, which it's the duty of the entrepreneur to take care of the society in which they operate. So Adam Smith was quite a person who's interested in the community, and I think a lot of business people are realizing that, and we see it. And I don't think it should be something that's not related to your business. We've seen, if you look at Alcan, the aluminum company, they're very big in education. They don't do it for CSR. They do it because they want to train their workers in Africa to be able to drive trucks and use the technology and so forth. It's a win-win. It's what Dick was talking. And so they're actually putting a lot of resources. They're one of the biggest contributors on that side, on the educational front. So I think there is that shift. You mentioned the Paul Pullman side of things. I think you're seeing more business leaders step out, because you know that if you don't, and Michael Porter talking about, again, the stakeholder, if I could, I'll shut up in a second, but I actually think I think there's been a shift in capitalism that started, the last one in the late 1960s. We became very focused just on shareholder. It was Milton Friedman, who's done much good work, but one of the things was, it's the business of business is business, and don't waste your bloody time with the other things that are going on. We became also much more short-term, right? Our average share in the New York Stock Exchange was held for 8 years. In the 1970s, it's now 8 months if you go through it. So I think we became more narrow and short-term. And I think a lot of business leaders are saying we have to be more broad-minded. Let's do it appropriately to what we're good at. We're not going to go fling ourselves on some cause that's not related. I think the boards would have some discomfort with that. But we have to play a role in the community. And I think the other thing I'd say is trust levels in business are very, very low. CEOs are it's not popular. And that's dropped too. 1960s Gallup, it was about 66% trust in business leaders. It's now, Edelman saying, around 47%. And I think it'll get worse with this inequality thing. I couldn't agree with Jim more. Inequality is not the duty of government to fix. It's business people have to get involved in that. If we don't, we're going to end up, I think that you said, we're going to get some system that we don't like. It'll be bad.
I'm going to open it up, but since you've both brought up inequality, and we're talking about management and shareholders, so we saw 2009 to 2010, 93% of the income gain went to the 1%. You know, the Occupy Wall Street movement might have had, some activity that wasn't very productive, but they were on to a point. And a lot of this inequality has happened since 1980. And so in 1980, the average CEO was paid 40 times the average worker. And in 2011, it's 287 times the average worker. Now, that to an average person sounds excessive. Do you believe that the CEOs, and I agree with both of you, that people are bringing up the inequality issue who are sitting in the seats where they can make a difference? Do you believe that CEOs are willing to accept some responsibility for more equal sharing and yet remain, 40 times is still pretty good. Do you think there's that much concern that maybe there's going to be a riot in the streets if we don't do something?
Well, we certainly have spoken out very strongly about CEO compensation and board's responsibilities in ensuring that CEO compensation is at least aligned with the investor imperative. We have not spoken out as to what is the appropriate level. We really think that's up to each board and each organization. So we haven't taken a stand that way. But there is, you put your finger on an interesting point. There's a whole bunch of things happen during that period. One is a whole focus on short-termism, a whole focus on stock options, a whole, which seemed at the time to be costless. And so organizations just papered the walls with them to find out they were very expensive. So that whole short-termism, which merges or works well with our third pathway of saying we need to be more focused on the long term. And boards really were asleep, and they let this thing creep up on them. A little bit, and now they're having to pull it back, or they let it creep up maybe because they were the beneficiary of it creeping up. But I think they're looking at it now. We probably have overburdened many of these boards with just straight compliance stuff, and they're not thinking enough about strategies and alignment and things like that. Because they're spending 90% of their time on compliance, which really doesn't do that much for us. So there's a whole bunch of forces there. The other big force is when you talk about an investor looking at whether we want to call it responsible investing, ESG, whatever. For years and years, or probably the biggest challenge that we have with our young analysts, et cetera, is if it doesn't fit into the spreadsheet, if there isn't a cell, how am I supposed to analyze this? And it's true. That's true. And then so, the fastest way to get many of these factors to be taken into consideration is to somebody figure out how to quantify it, and we'll get them in the model. They'll be, cell number, row 52, and it'll be in the add-up. And so what we've endeavored to do is, work with the people who are making investment decisions day after day to endeavor to ensure that many of these non-financial or not easily quantifiable factors are brought into consideration. The classic example that I always use, because I had an assistant who came from Mauritius, was I might find the best utility operation in the world operating in Mauritius, and I can have this great model that says I'm going to get X return. But, it could be 6 feet underwater in 10 years. and it's not going to help us. And so, you got to bring those factors into consideration. She never liked it when I said it.
Very good. Dom, do you want to?
I think that
was it. Okay, do we have any questions for, oh, yes, oh dear.
Oh my God.
You're the first person I saw. If you could identify yourself, and that would be very nice. Thank you.
I'm Wei Jacobi from the Center for Transatlantic Relations. So the premise, as I understand it, is that capitalism has an interest in making some of these moves on its own, not obliging the state to intervene. And I agree with that. But as a political scientist, one of the things we point out over and over again is that people often have an interest in doing something and then very rationally don't do it. A good illustration would be the European economy right now. Lots of people think we have an interest in having pro-growth policies, but those are expensive. And so one state after another resists the temptation to do pro-growth policies, but hopes very fervently that other states will do that. And to a certain extent, the Germans have done a bit of that. But no one has an incentive to really actually do it. And here, when I think about the situations you're describing, that seems to be an even more extreme case of this. Because it would seem to me that every CEO or every management team would have an incentive to say, we should keep the wage structure in our firm more or less as it is and hope that everybody else is more fair to their workers. That will help the legitimacy of capitalism more generally. It'll help purchasing power in the economy, and it won't oblige us to move off the position we're in right now. And so it's just really hard for me to think, and the data you present makes it even harder to think about it, because when I think of ratios of 287 to 1, what that says to me is that every single day that I go to work as a CEO, I make the annual wage of my lowest paid worker every single day. So it seems to me that the incentives are so locked in for every firm and its management to wait and see, even while they all share presumably an interest in moving. It's not obvious to me how we get anybody to move in large enough numbers. I grant that certainly you can find people who are moving, but in large enough numbers to actually fix this problem without any kind of intervention from the outside.
Yeah, I mean, I think you make it's a great point. I mean, one of the challenges is you take the financial services industry, because one of the arguments you'll get, a board may say, well, we need to lower the compensation, but then you've got the if I could call it the key man risk. Well, I have to be careful, because if we lower it, they're going to go somewhere else. So we'd like to do it, but the market, it makes it difficult for us to do it. The only thing, as I would say, is I actually believe that compensation will drop in the financial services industry. I think you're going to see I think there's going to be a change, and it's happened in history. If you look at, there's some very good work. I can't remember the name of the professor that actually looked at not only the sort of the 280 to 1, but if you actually looked at financial services versus industry, what CEOs were paid, right? There was I think back in the early 1900s, it was something like 1.1 to the financial services CEO to the industrial CEO. And then that actually spread. I think it went to something like 1.8 or 1.9 right up into the Depression. Right, that just before the Depression, the numbers broke. And then after the Depression and after basically the financial system became more of a utility, you had Glass-Steagall and so forth, it dropped right back down to 1.1 all the way until about the early 70s. Gillian Tett's got some good research on this, when you then had the moving away from the gold standard and so forth, and the globalization. So I think these things have happened before, and I think investors can play a very big role in it. I think the other part, though, I have to just say is, I think we have to be careful, though, about having rules. I for one, wouldn't vote for a CEO pay can't be X times Y. I don't think anyone has any difficulty that Steve Jobs made the sort of money he made. I don't think you'd find the average worker that would find a problem. Someone who took risk, created something, and built it, and I think that it's there. I think where people really get annoyed is when there isn't the risk-return match that's there. And I think boards should get really irritated with that too. And so that people who, they may generate a lot of wealth, but then that they just destroy it afterwards. So the changes, not only in sort of the absolute amounts, but the amount of risk that people are taking and where it is an area to work on. I don't know. So I do think there could be some movement. I think investors can play a role. Jim would be much more qualified than me to talk about that. And I think boards would. And I do think that that's a discussion. And if we could get away from dealing with fiduciary compliance type stuff and deal with more long-term things, maybe we'd get more action. I don't know, Jim.
Well, I mean, it does take shareholders saying, we don't like this, and they've got to exercise that by making changes to the board. I mean, it's quite amazing how many, every time we vote against management, I don't sign off on it, but there's sort of three of us advised, in case it's one of our friends, we got to phone and say, hey, guess what, we're voting against it. And I probably get 2 a day where we are voting against a compensation plan in an organization. We're not the majority, but eventually people will get on that. And we will remove the person who was the chair of the compensation committee the last 2 years when Charlie Bloggs got some huge raise when the profits of the company went in half. But it'll take time.
That's great. Madam, white hair. Can't quite see you. I need my glasses if I'm going to do this.
Thanks. Obviously, at the end of the day, it's where the rubber hits the road is where...
You've got to identify yourself.
Right. Howard Rosen, here at the Peterson Institute. So at the end of the day, the rubber hits the road. It's where the investment takes place that creates the jobs. I want to take advantage of the fact that both of you from Canada, productivity rates in Canada are half what they are on average they have been in the United States over the last 10 years, yet gross capital formation is about 30% more than it's been in the United States. And as you know, we've got about U.S. companies have about $2 trillion of profits sitting on their balance sheets that they haven't been investing in the United States. So what do you guys know that we don't know down here? Is your education system, your training systems 30% better than ours? Why is the investment taking place in Canada and not here?
That's the question you've been waiting for, gentlemen.
I'm not sure. I mean, the Canadian manufacturing base has been eroding quite substantially. That's largely been because we've moved from a 60-cent dollar to a $101, and that's hurt dramatically. So the investment hasn't been going there. Where the investment's really been going is into natural resources. I mean, that's what's fueling the Canadian economy. There's a stall right now because we don't have enough pipelines to get the oil which we're capable of producing in Alberta out of Alberta, and that's a big concern to everybody. But I mean, we've all sprained our arms patting ourselves on the back for having come through 2008, 2009. Our banks are in good shape, yada, yada, yada. There's a lot of luck to that. I mean, I remember it was 15 years ago when all the Canadian banks, all of them, there's 6, talked about merging, and they were prevented by the government. I guarantee you if they had merged, they would have then said, oh, geez, I guess we got to buy some mortgage operation in Phoenix. And they would have been in exactly the same position that most of the U.S. banks ended up in. So, it was serendipitous. We shouldn't be patting ourselves too much on the back. We also have only 6 banks. So the bank, the governor of the bank only had to make 6 phone calls to find out what was going on in correcting things, etc. The regulators only got 6 that they go visit. So it's a very, very different environment from that way. Our productivity gains have not been anywhere near what the U.S. has been. I mean, that's the big thing that we're fighting in Canada at the present time.
You know what, I might just make a comment that's nothing to do with Canada, but it's just a story about Jim, actually. I've said this before with him. I remember I was in Brazil, and I was meeting with a private equity fund called Tarpon. And these guys, they look like my kid. They're young guys running around they're building this business. They said, they basically were key people in building this company called Brazil Foods, which is going to be one of the most significant ag food companies in the world. And I think if you're a long-term investor, that's something you'd want to build in. And I said, well, who's investing behind you? I mean, where do you get the money to be able to build this enterprise that's going to be important over a long period of time? And they said, oh, you probably haven't heard. They didn't know I was Canadian. They said there's this group of retired teachers in Canada that are actually backing us to several $1 billion, right? I said, you've got to be kidding me. Ontario He goes, yeah, they're, I don't know if it's a couple of $1 billion teachers. But it was, what I do think, the point I'm trying to make is, I think the need for long-term investors, and I don't have the facts on U.S. versus Canada and where it is, but I come back to what Lynn said in that Economist magazine, looking at ranking, if you will, higher performing players. There did happen to be quite a number of Canadian pension funds in that group, and I think if he or she who has the most long-term investors, in my view, is going to win. And I think because you see the Canada Pension Plan is also investing in Chile and in Brazil. The other thing I just say on this is we've been looking at emerging markets versus the developed markets companies, right? The peers. So if you look at a Unilever versus the up-and-coming Chinese player that they're with, or you look at telecom. And what we found is that the emerging market players are investing at double the rate that their peers are in the West. They're more long-term. Part of that's because they have long-term. Some of it might be state capitalism. We have to be careful. That's a whole other topic we can get into. But I do think this, my own sense, I just want to say is, I don't know if it has anything to do with Canada, but I think there's something about a competitive advantage in having long-term players, because then you can build these companies that are going to be players over time.
Interesting. Oh my goodness, there are a lot of questions, and Adam just told me we have.
Take two.
I'll take two. I know I'm going to take this woman. Sorry. Diversity, inclusivity.
Kate Ambrose, Latin American Private Equity and Venture Capital Association. Dom, you set me up. Tarpon's a member firm. And of course, we know OTPP is very active along with a number of other Canadian pension funds in Latin America. Actually, the ESG topic is an interesting one. We have seen increased emphasis from European and Canadian investors in particular with ESG requirements before they'll make a commitment to a fund active, particularly in emerging markets. So I was going to throw that question out before Lynn did. The question I actually have for Dom and Lynn on coming back to the governance and compensation issues, to what extent are you looking at the role of education, and I'm thinking MBA programs around business ethics? This is something that Luigi Zingales has written, prolifically about, that's really the point at which you can influence change in the leadership or the decision making that's ultimately going to come in. So is that a focus for the Henry Jackson Initiative in terms of business ethics and MBA education?
That's a great question, and the short answer is yes. Ethics is very important. In fact, when I came home from the first meeting, Jim is on the task force, Adam's on the task force. It's a great group. You'll see in the back. I said to my husband, I said, well, what do you think, is the key to making capitalism, more acceptable? To capitalism is under siege, and he said, get people to behave better. And that's really an ethical question. And that Dom referred to Adam Smith, the father of capitalism, 17 years before defining capitalism. He wrote the Theory of Moral Sentiments. And his underlying belief was that capitalism, that the free markets work and the invisible hand works because we care as individuals about how we're regarded in our community, and that we care. There are institutions that give us an ethical bearing. So greed is not good in his book. And I think that a large part of what the movement toward inclusive capitalism is about realigning ethics. That it's not about murky ethical behavior or narrow interests. And that's very much part of what we do. So
we, for example, we're signing up to send some of our people to go. And I do think business schools, it's a bit like what Dick said about labor and how you engage with people. I think that's something that needs to be shifted, but values is for sure there. And the challenge is, most organizations have wonderful values on their wall, it's again whether they actually behave, and how do you reinforce that? How do you teach it, and so forth? So those are early steps, but that's definitely on the table.
So really, one more question, Jacob. Are you someone not with the Institute? Isn't that Adam? Isn't that the rule? Okay, yes. This gentleman with the glasses, yes.
I'm Harold Meyerson. I write an op-ed column for the Washington Post, and I'm an editor of the American Prospect magazine. I'm encouraged at a level of theory that I'm learning that shareholder capitalism is now being rejected, and that inequality is viewed as a real problem by business executives. But while we're talking about worker training and business ethics, we're not really discussing the question of power inside a firm. At the moment, wages of American workers are the lowest share of GDP they've been since they started measuring in 1947. Compensation is the lowest share of corporate revenues. I think this is somewhat linked to the disappearance of collective bargaining in the private sector in America, where only 6.9% of workers are unionized. And unions like Tom Buffenbarger's do a really significant job for their members, but they're not really anywhere near exercising the kind of power for workers that workers enjoyed 40, 50 years ago when prosperity was much more broadly shared. So I particularly for Mr. Barton, to what extent can you envision actualizing a more stakeholder version of capitalism? Germany has works councils. There's co-determination in the German economy. Here, labor law is a joke. You can't unionize workers. Even if you can unionize workers, 40% or 50% of the corporations don't even agree to sign a contract once the workers have won an election. That was what the fight over labor law reform was about here. So explain to me how far you think American corporations are willing to go institutionally in the question of creating a more stakeholder version of capitalism.
Well, maybe I'd say two things to it. One is maybe coming back to something Dick mentioned at the beginning, because I don't want to sound Pollyannish either, right? Which is we are in a more borderless world, capital's flowing, and so people, a CEO does have returns that they have to make there, and you can argue, what is that company an American company? Is it what type of company? What was McKinsey? Are we American? Who are we, right? We're in different countries and so forth. And so there's less of a sense of you belonging to a particular place. And so you then look at, you've got to compete, and you've got global competitors. I just want to make sure that that's there. So I think we can't have something that's fake or that's somehow a barrier. You have to be careful about a barrier, because I think it'll get blown out, because you've got part of, I think, the compensation issue that's gone on is you've had 400 million other people enter the workforce that's come into the system, and we have to deal with it. So I just want to, that's a context. I think where you're going to get the biggest benefit is from two dimensions, and I do think that U.S. CEOs think this way. And one is around this win-win notion. It is, you can make more money, you can make more profit, and we saw that if you engage, if you embrace workers in it. And I think that example that these guys talked about with Spirit is one. It's very interesting. Again, it was Onyx, the private equity firm, hardcore capitalist, I want to make money, God damn it, type of, that comes up. It's interesting. I think it's a very interesting combination.
And the lead guy now is the chief of staff for the prime minister.
Is that right? Yeah.
Nigel Wright.
So I actually think this notion of it being a win-win, right, that we're going to be able to do this, and that CEOs realizing it. I have to say, too, from working in many organizations, I'm surprised. And by the way, I look in the mirror when I say that we figured this out. The lack of understanding about the talent that's in the organization at that level. Luckily, I remember the first CEO I worked with, John Teets at Dial Corporation, who we're doing work with Greyhound bus lines. And he reamed me out for about 2 hours saying, why didn't you spend time talking to the bus drivers about route profitability? Because maybe those guys actually know how many people are in the goddamn bus, instead of doing your spreadsheets, which is what I was doing. And so you'd be surprised at the room that's there, and I think that's something that we're going to need to do. And that's where the training comes in, so I think it can be there. And the last thing I'd just say on that is I also think investors can play a big role. I'm very much where Jim is. The problem with these ESG and stakeholders is it's a bit wobbly, right? It sounds, environment, labor relations. We do have to figure out, and that's something we're trying to work on in this Henry Jackson initiative, is to get metrics. That's something that Lynn and I have talked about. How do we get some metrics that people can measure? One thing, for example, we've looked at, there is now they call it a sort of a labor alignment diagnostic that's been done for about 1,000 organizations. And that's not a very good measure, but you can actually start to measure as to how aligned the workforce is and the different levels of management. It isn't just the frontline workers all the way through. And so I think we're going to start, I hope, I think long-term investors will push this, that we can actually get some metrics to say, we actually think it's a performance improvement lever. How well have you engaged your labor market? Unfortunately, I can't go any further. I don't have, it's all fluff below that, but I think we'll go there. And that's also where I think the innovation is going to come. All the lean work, and by the way, there's not I think a leading organization that doesn't do lean or some version of it is all frontline involvement that's there. And I think you can't be competitive unless you do that, and that's engaged workers.
That's excellent. That's excellent. I think we need to move on and thank these two great Canadians, citizens of the world. Thank you.